All right, welcome back. We are going to talk through a depreciation example here, just so we actually have numbers and we can wrap our mind around it. Because remember, depreciation is viewed as an expense to the IRS. And so we're able to deduct that amount from our taxes, but it's not actually an expense of ours, right? We're not actually spending money on this thing. It's just an expense that is accounted in our favor, but we don't use our cash flow for it. So our cash flow stays the same. We just end up getting taxed on less, okay? Or potentially zero. So it really depends. So let's walk through this so you can really understand the concept. Let's say we have the property like above, okay, a $250,000 property. The structure is valued at $250,000. So plus the land, it might be a little bit more than that, right? Rental income, let's say, is $2,000 a month. Okay, so that's $24,000 a year. Expenses, so this would be property tax, homeowners insurance, mortgage interest, property management, whatever it is, $1,200 a month. Okay, so our net cash flow is $800 a month on this. Okay, now you might not see $800 a month because the principal portion of your mortgage you're still paying, that's out of pocket. You're just not taxed, or you don't get a deduction on it. So realistically, maybe you're seeing a little bit less actual rental, like net cash flow to you, because you're still paying the mortgage, the principal amount, but 800 is going to be taxable to you. So that's one thing to keep in mind. If you are getting taxed on $800, for example, per month, but your net cash flow is actually zero, then you're not earning any extra money. And then you also owe taxes on $800. Okay, so again, this goes back to our real estate investment analysis and really making sure the cash flow makes sense, because you don't want to have a property and be negative cash flow because of your taxes you're paying. All right, but anyways, that's kind of a separate topic. So let's bring it back. Taxable income then is $800 a month or $9,600 per year. So that is our taxable rental income each year. Now, let's look at if we just scan right above here, we look at the depreciation on a $250,000 structure divided by 27.5 is $9,090.90. So that's the depreciation we can claim every year as an expense. Now, again, we're not expensing this. We're not using cash. It's just we get to claim it as an expense. We depreciate that. So we have $9,600 a year of taxable income, rental income, subtract out the depreciation, and that brings our total taxable rental income to $509.10 per year. So even though you're getting $9,600, you're only taxed on $509. That is pretty sweet. So you can ride this depreciation. And then again, when you sell, then it just is kind of added back in the form of a capital gain. You pay capital gains on all that. So you're deferring taxes till later. Now, there are ways around that. I'm going to talk about that in a future video through the 1031 exchange, but this is how depreciation works for this example. Okay. Now, there could be the situation, especially if you're doing accelerated depreciation or bonus depreciation, where you actually have a net loss in a given year on your property. So what do you do, right? We talked about investment losses before, deducting against income and things like that. Well, this is treated slightly differently, okay? So if there is a net loss for tax purposes, you can deduct it against other passive income. So let's say you have a net loss on one property, but you own a couple others where you have a net gain. You can deduct it against other passive income. So that's totally fine. Passive losses deduct against passive income. Or you can also potentially deduct it against other active income, like your job, like W-2 wages or 1099 money that you earn. You can potentially deduct those losses against that. Now, there are limits here. So let's talk about the limits. If you have earned income of $100,000 or less, then generally speaking, you can deduct up to $25,000 a year in passive losses against your earned income. That starts to phase out between $100,000 and $150,000. And then once you have over $150,000 of income, then they no longer allow you to deduct that $25,000 of passive losses against your income or any amount. They don't allow you to deduct passive income or passive losses against active income. So There is, again, a way around that potentially. We'll talk about that in a future video by talking about real estate, being a real estate professional for tax purposes. Okay, it's a tax status. But just in a normal scenario, if you're earning more than 150,000 and you have a net loss on your rental properties, then you can't deduct it against other income. So once you've deducted against all of your passive income, then the only thing you can do is carry it forward to future years. Okay, so if you do bonus depreciation and have a ton of losses in the first year that you're not going to have in the year 2, 3, 4, 5, then you can deduct it against income in those future years until you've recouped your loss. Okay, so it's not all lost, but it's going to take a little bit to recoup it. All right, so that is how this example works out. So you can see it's a huge benefit because the IRS treats it as an expense, but in terms of your own cash flow, it's actually not an expense. Plus, you get tax savings on top of that. So if you do the numbers right when you invest, you could potentially have a lot of income and pay tax on none of it if you have expenses, right? If you have depreciation worked out the right way, right? If it's the right type of property, you could earn an extra $100,000 a year tax free because you have depreciation of $100,000 a year in like bigger commercial type properties. So a lot of potential there. There's a lot of really, really smart people that figure this out. So if you're trying to figure this out, then work with a professional. It's just worth it. Cost segregation studies, you want somebody to do it. Maybe you pay 10 grand to get them to do it, but maybe it might save you $40,000 in taxes. That would probably be worth it, right? That's how the example of depreciation works. And then we'll wrap it there and let's move on to the next video.
Numbers make it real.